Okay, hold on a second. You see my screen now?
Yep.
Okay, so what we were talking about on Friday was this single leg dashboard. Okay, so I'm going to close this. So if you go to SPY or whatever stock symbol you put in there, you land on a summary page, and under options, the single leg dashboard, that's the page we're on right now. So I'm going to just close this menu to expand the screen. And we discussed that this page analyzes option trades, calls, and puts that are not part of a multi-leg uh, strategy when they were entered into the market or contingent trade. So when they were entered in the market, it was entered in and executed as a single leg trade. Okay. And then we take those trades and we perform analysis on them to get more insights on the order flow and how people are using options, how in this particular stock symbol. So now we're on SPY. And we went over the top. I believe we went over all these last week up top, and we got down to this part of the analysis where we see the graph. And let's just continue from here. I'll do a small recap, and then I'm going to keep going uh, down and talking about, what we're trying to analyze from on these reports. And what you see here visually, graphically, uh, are a couple different things. One is we're looking at the trade volume, the distribution of trade volume in the single leg trades, calls and puts in SPY, and we see it based on the different option expirations that are available. We also have two charts that are tracking the implied volatility, the at the money implied volatility of the options in that expiration. So the idea here is to first look where the trading volume is. And the next question is, how were the options impacted from this trading volume? Okay, so what happened to the options? Did the option prices go up? Did they go down? And we look at it from the perspective of implied volatility, because that's their relative value. Implied volatility goes up, that means option premiums are getting pushed higher. If implied volatility is going down, that means option premiums are going down. So let's look at this graph first. And what we see here is these are the different expirations that were available Friday. We're not open yet, so this is as of Friday's close. Starts at August 2nd. Then we got over here August 5th, August 6th, August 7th. So these are all the different expirations that we see available in SPY to trade. That means these expirations have listed options. And if they have listed options, they'll have bids and offers, and they're available for trading. Well, how much trading, was there in these expirations? And where's the concentration of volume? So this tells us over here that the majority of the volume was in the 0 DTE options, those were August 2nd. And keep in mind, this report is as of August 2nd. That's when the markets are not open yet on August 5th. So this is all trading volume from August 2nd. And so here we see that most of the volume was in the 0 DTs. After that, we see there's the next biggest expiration as far as trading volume was August 5th. And then you see that the volume kind of tapers off on a relative basis, right? Um, Another thing that we could do is just look at these bars and you see that they're stacked, yellow and blue, right? The yellow bar represents the volume in the calls. The blue volume represents the volume in the puts. So if you see a big bar all blue, that would indicate that most of that volume is in the puts. If you see if you see the bar spiking up and it's mostly yellow, that would indicate that the volume is mostly in the calls versus the puts, right? And in this case, it looks to me, just eyeballing it, that it's pretty much 50, it looks 50-50, close to 50-50 visually. We could go check, but this is visually close to 50-50 between calls and puts. Um, so that's the insights based on the volume distribution. Basically, just from this alone, from a very quick eyeball analysis, people were using options in SPY in the short dated options, 0 DTs, and then the next day. And that's typical in SPY. If you look at this chart from day to day, you'll kind of just know that, if you trade SPY and you use this report on a daily basis. So then let's go to the implied volatility lines. Now that we know the distribution of volume, the next part, well, how were the option premiums impacted on Friday? And we draw a couple different things here. One is we have this gray line, right, that doesn't have these green and red dots. So this is a solid gray line. The solid gray line represents where the implied volatility of this same option was the day before, the previous day. Because how do we know if something went up or down? Well, we need a reference price, right? We need to know, well, what was it the day before versus the day after, right? That's how we could tell that something got the impact was higher or lower. We need a reference price, right? So this is looking at the reference price from the day before. That's what this solid gray line is. The reason we look at the solid gray line going across different expirations is because the implied volatility, each expiration has its own implied volatility. It's not like, implied volatility is 20 and every single option is 20. It doesn't work that way. Implied volatility can be different for different options based on, strikes, based on different expirations and so forth. So we need to kind of see it in front of us. We need that picture, right? And that's why we get this gray solid line to show us what the implied volatility looks like for each of these different expirations. And we could see relative to each other what it looks like, right? So what does this line tell us is that on a relative basis, the implied volatility in the shorter dated options is higher than the implied volatility in the longer dated options. We could see that visually right now. What is that? So what does that indicate? Like, what does this mean? Well, if you're used to looking at this term structure in SPY, and intuitively, when things are calm and there's more certainty, right, this will look in the opposite direction. What it will do is that the short-term implied volatility is usually lower than the longer term. And that makes sense because as you go out further and further in time, there's less and less certainty. There's always something, chances of things happening or more things happening as you go out further in time. Like for example, you know, usually the next day or the day after, we kind of have more certainty of what's going on, the news cycle, what type of reports are being uh, announced by the government, economic reports, Fed meeting, all this. We have a little bit more certainty and clarity, but as you go out further and further in time, there's more and more things that could shock the markets, right? As like a COVID or whatever. So you would usually see this in the opposite direction. So what's going on now is that this term structure, the way it's looking now, is not a usual normal term structure. Okay. That term structure is indicated that there's something unusual going on right now in the market. There's less liquidity and an unusual amount of volatility expected by the market. This is what the term structure right now is telling us. It'll look like this even when, if you guys trade earnings, you'll see the term structure also pop up like this, because what happens is during earnings, well, the market is expecting more volatility because they know an event is coming. They know that somebody's going to release earnings, but if you don't know what it is, well, then you expect more volatility, that there's going to be some kind of information released that could move the market or move the stock. So that's what this gray line is indicating to us, that, well, the markets are signaling something. The markets are signaling that we're in for some, unusual volatility and illiquidity in the marketplace coming up. So then we have this new line, right? Now we have this new line to compare to the solid gray line. And this new line here is the dotted line. That represents the most current implied volatility. And keep in mind that implied volatility, it's comparing the at the money strike, the most recent at the money strike, to that same strike the previous day. Okay, so we're looking at strike versus strike. Okay, so what are we seeing here? Well, that new line on Friday shifted even higher, meaning that it got even more pushed to the term structure, got even pushed out even more to that inverted type of yield curve, right? Like you could see that the near term options increased again, and the entire term structure looks like got pulled up. So as you go out in time, that got pulled up as well. So all implied volatilities went up across the board, and the nearer term got pushed up higher. So Friday, the uncertainty and volatility expectations increased, right? The fear or whatever, the markets are feeling right now, it's increasing, right? The uncertainty, the fear, the uncomfort or is increasing. Okay. The green dots represent that the implied volatility is just up from the previous day. The red dot represents that the implied volatility came in a little bit, or came in from the previous day. And we put that in there just to indicate to you, which way the implied volatility went. And if you have this like just black dot, that just means it was unchanged from the previous day. So this could be just, this is not a liquid expiration. So that's what, we could learn from this graph, a picture of what's going on in the options. What is the distribution of the trading volume between different expirations and the calls and puts? And then how were the option premiums or implied volatilities impacted, from this trading. All right, so that's this graphic. So let's like slide down, and now we got this table view. Okay, this table view shows us the numbers. It's not so it's instead of a visual, it shows us the actual, numerical numbers. And because SPY has, lots of expirations, you could tab through it or you could just open them all up from here, show me all of them. But let's just stay on the first 10. So these are the first 10 expirations, and you could see August 2nd, 5th, 6th, 7th, 8th, 9th, 10th, up to August 15th. So it looks like that in SPY, it's a popular ETF, popular to trade options. They have options that expire, from 0 at least to the top. Let me see. First 10 days. All right. Day one day to expiration, 2 days, 3 days, 4 days, 5 days. So there you go. Now looking at these different expirations available, we could look at over here. Do we capture any type of events that may cover that expiration, which could be important? So we would tag it here. Now we don't capture every information type of event. We're looking for stuff. If we find it, we'll list it. Doesn't mean that we know about all of them. So an event could be a dividend, next dividend date. That's material to options. We'll list it. In a stock, you could have earnings or company event. If we capture it, we'll list it here. Okay. It could be other types of material events. If we capture it, if we see it, we have a team of people looking through press releases and stuff. If we capture it, put it into our database, it will appear here. The next thing is we see what the at the money implied volatility is for that particular option. So you could see here, August 2nd really doesn't, that one already expired, so it's done. But August 5th, 6th, 7th, so you could see the at the money IV. And if you just scan it, you could eyeball what it's doing. Same thing here, what's going on in the graph. Then what we looked above, right? What we did was we looked here at what the implied volatility term structure looks like. How does the implied volatility change as you go out further and further in time? So that's what we're seeing. But what about within expiration, right? So within an expiration, you have different strikes. And because you have different strikes, you could have different implied volatilities. Each option could have its own implied volatility, right? But how does that look like? So without drawing the graph first, because we would have to click on it and draw the graph below, to get an idea, we could use some reference numbers. Okay, so if we take the implied volatility of it at the money IV right here, that strike is 25.9. Well, what does a strike below look like, right? Where is the implied volatility increasing as the strikes go lower, or is it decreasing or staying the same? And by how much? So just to get a sense of what's going on, we could say, okay, compare the at the money IV to a 25 delta put, and compare the at the money IV to an upside 25 delta call. Okay, so if I ran the same implied volatility through each strike, and then I said, okay, if I ran 25.9 on each strike and then compared it to a 25 delta put, is it the same? Is it 25.9? If it's not, what's the difference? Well, the 25 delta put here is 4% higher. What if I ran 25.9 volatility through every strike available And then I found a 25 delta call strike and said, well, is it the same as 25.9? It's not. Okay, so what's the difference? Here it's saying that is 2.8% below. So this lets us know here, you could see here, on a relative basis, what is a downside 25 delta put versus 25 delta call look like relative to that, the money. And we see here that as the strike goes lower, implied volatility goes higher. As the strike goes higher, the implied volatility goes lower. Okay, that's what that is what the implied volatility skew looks like. All right, so that gives us an idea how the implied volatility skew looks like. And we see that for each expiration will be different, right? Each expiration can have a different vertical skew. So this next one over here says, okay, this is what it looks like. Right now, the 25 delta put, let's say, is 4% higher. 25 delta call is 2.8% higher. But how did this look the day before? Just like here, right? We're like, okay, we're on this gray line, right? So we're on this gray line, but we want to know, how did it look the day before? Did these options increase or decrease? Like how did the trading activity change them today? So this is what this is doing, comparing it to the previous day's close. So let's just say, and really we probably want to go out a little bit further because, you know, one day DT doesn't, with the implied volatility, doesn't tell you much, but let's just stick with it. So what this is saying is that that same strike that we're referencing here was up 9.3%. The 25 delta put that we're referencing here, the implied volatility was up 15.9%. And the 25 delta call that we're referencing over here, that implied volatility went up 11.9%. Okay. So what it's saying is the implied volatility on all those strikes at the money, 25 delta put, 25 delta call, increased on all the strikes from the previous day. Okay, that's what this is showing. And it's shown that that 25 delta put that we're referencing right here had the biggest increase, 15.9% versus at the money's 9.3 and the 25 delta call 11.9. Okay, so we're right up at 9:30. I'm going to stop right there. And then we could just continue on this tomorrow.
Great job, dude. That was a real interesting look, particularly with the market selling off the way it is the last couple of days. Awesome job, my friend. Thanks everyone for joining. Everyone have a great day. Thanks, buddy.
Thanks, everyone.